Hey everybody, Eric here. So this is the first lesson in the strategies playlist. I'm gonna just go through in some sort of order, starting with single options, and then we'll get into strategies a little bit later. But it's important to understand the basics first. So let's jump over to the main screen and work through what a long call is. So it's a bullish trade, meaning that whatever position we put it in, we want it to go up, and it gives the owner of the option the right to buy an underlying at a specific price by a specific date. Now, we'll go through an example in a moment, so just kind of hang with me, just doing a quick overview here. The max profit for the trade is unlimited, meaning as the underlying continues to go up, the P&L will continue to go up of the option. The max loss is defined, so it's the debit paid to open the position. That's the most you're going to lose in a long call. Your break even price, this is where at expiration you would be profitable at or above. It's going to be your strike price plus the debit paid. Now, I just threw a couple market scenarios in a really simple way to tell us how it's going to work, in different market conditions. So if the underlying goes up in value, that's good for the long call. If the underlying goes down in value, that's bad for the long call. If implied volatility increases, that's good for the long call. And if the implied volatility decreases, that's bad for the long call. The reason being is if the underlying goes up, premium increases, the value of calls increase, the value of the option increases, that's good for you. Buy low, sell high. Same thing for IV. If IV increases, premium increases, value of the call increases, it's good. Buy low, sell high. And the exact inverse is true if the underlying goes down or if implied volatility goes down. So let's talk a few, just general notes for these. I tend to target low implied volatility trades. If I were to trade a long call, it's very, very rare I do. And if I do, it's a leap diagonal of some sort. I don't just trade long calls. But that part aside, if I were to trade a long call, I would want something with low IV so that IV has more room to expand, which would help my position. Because if you buy long calls when IV is high, there's a higher probability that IV will come down, vice go higher still. So that's why I like to buy at low IV. And the way to think about these positions, it's essentially being long stock. It's a cheaper way to be long stock. And then just for a general understanding, to enter the position, you're going to buy to open. And then to exit to the position, you're going to sell to close. So again, just like stock, very traditional, nothing too complex here. So let's take a look at a trade. Here I have the SPY, the 13 July 325 calls, and they're currently trading at $5.61. So that's the debit you would pay. That's your max loss. And then this is called a P&L chart. This shows us how our position is going to look over time. The blue line is at expiration. The purple line is right now. So what happens is, as time passes, this gap between the purple line and the blue line is theta. And since theta decay, as time passes, theta bleeds out of an option, it hurts this position. So this purple line, as time passes, is going to normalize to this blue line. So that's why it's important when we trade long options that they're very directional. They need to move in our direction and quickly. Otherwise, we will be holding a losing position. And notice, if by putting this position on here right now, we would have a max loss unless the SPY moves in our favor. It's got to go in our direction quickly for us to make money on this kind of position, or IV needs to contract. One or the other will help the position. So that is a down and dirty look at the long call. Next up, we will take a look at the short call.